Hi there, confused about whether joinery work falls under CIS? Let's explain workshop manufacture versus on-site fitting and why the distinction matters.
You manufacture high-quality joinery, but a significant portion of your working capital is being drained at the exact moment you issue your invoices. Consider a standard commercial scenario. You secure a contract to design, manufacture, and install a bespoke oak staircase. You complete the work and submit a total invoice for £30,000. This document illustrates what happens next. The main contractor receives the bill and deducts a flat 20. By calculating the precise deduction base using the latest 2026-27 HMRC rules, you can retain your working capital while staying strictly compliant. The construction industry scheme applies strictly to payments made for construction operations. However, HMRC Internal Manual CISR 14220 explicitly states that manufacturing building components or materials off-site is excluded from that definition. Look at this isometric map. The green workshop is an exempt zone. Building items inside is manufacturing, not construction. The moment goods cross the boundary onto the active site, the exemption ends. Under CISR 14150, physical installation is caught by CIS rules. The law divides your trade by geography. Making goods is an exempt production process, but fitting them is a taxable construction operation. Most independent joinery firms operate on a supply and fix model, quoting a single price to build the item in the workshop and install it on the client site. This triggers the mixed contract rule, detailed in HMRC Manual CISR 14030. When you combine a manufacturing obligation and an installation obligation into one commercial agreement, the entire contract is dragged into the scope of the CIS scheme. A common industry workaround is to issue two separate invoices for a single contracted job, one for the workshop fabrication and a second for the site fitting. As this document illustrates, HMRC strictly prohibits artificial invoice splitting. You cannot bypass tax rules by dividing a single agreement onto two pieces of paper. Because contractors are legally obligated to apply CIS rules to the entire mixed contract, you must rely on calculating a precise, segregated deduction base within a single itemized invoice. There is a vital legal distinction between a contract falling within the scope of CIS and a payment being subject to a deduction. Let's deconstruct the £30,000 invoice into three components. The £15,000 for manufactured goods and £5,000 for raw materials are excluded, passing directly to you. This leaves the £10,000 fitting labor. Applying the 20% tax here results in a correct $2,000 deduction. Compare that legally accurate $2,000 deduction to the original $6,000 blanket deduction applied when the invoice wasn't properly deconstructed. By itemizing your contracts in accordance with the legislation, you legally retain £4,000 of working capital on a single job. While separating materials lowers your deduction base, overclaiming non-allowable business expenses as materials can trigger a catastrophic HMRC audit failure. Allowable materials are items physically incorporated into the build. This includes raw timber, sheet materials like MDF, and the necessary ironmongery and adhesives. The actual cost of third-party plant hire, such as renting external scaffolding specifically for the installation, also qualifies as a valid material deduction. HMRC strictly categorizes overheads. Fuel, public transport, and skip hire are not materials and remain subject to the 20% tax. Crucially, you cannot claim wear and tear on your own table saws or vans. These are non-allowable expenses under CIS. During a compliance check, the main contractor holds the legal liability to prove that every material deduction they allowed was genuine and supported by evidence. Strictly segregating genuine materials from your general business overheads protects both the contractor and the subcontractor from severe financial penalties. The 2026-27 tax year introduced tighter administrative measures. HMRC is actively reviewing gross payment status holders and canceling that status more readily where compliance errors are found. If your business does not qualify for gross payment status, there is a structural alternative to mixed contracts, known as entity separation. Here's how entity separation works. Establish Company A to exclusively manufacture and supply goods directly to the client, placing it outside CIS. Then, Company B executes a separate contract for on-site fitting. Only Company B's labor is subject to CIS. HMRC Internal Manual CISR 14100 provides the legal foundation for this corporate restructuring strategy. This sophisticated approach legally ring-fences your manufacturing revenues, removing them from the administrative burden of the construction industry scheme entirely. The tax treatment of your trade comes down to location. Workshop manufacture is an exempt production process, while on-site fitting is a taxable construction operation. To protect your cash flow, remember these rules. When operating under a mixed contract, the 20% or 30% deduction should be applied exclusively to your fitting labor, never the total contract value. Granular, line-by-line itemization of your manufactured goods, raw materials, and fitting labor is your primary defense against overtaxation and aggressive HMRC audits. Whether you are a sole trader, operating through an agency, or directing an established limited company, applying these precise definitions will immediately impact your bottom line. This video is for educational purposes. UK tax law is complex, and individual circumstances require professional interpretation. If you are losing working capital to blanket CIS deductions, contact Atlas Tax Advisors. We will audit your current contracts, secure your gross payment status, or execute the legal restructuring required to optimize your joinery business. Reach out to our specialists today to get your compliance and your cash flow permanently sorted. Finally, like this video and subscribe to the channel to ensure you never miss the high-level tax insights that protect your business.